So, how can we use earnings, pricing, and dividend yields to compare companies for investment? Join me. Hi, folks. Welcome to The Way I See It, which is my podcast on all things investing, personal finance, and the economy. This week, I want to talk about some concepts that we have to understand if we want to be very good investors. Uh, Earnings per share, dividend yield, price earnings ratios, dividends earnings. Those are all terms you're going to come around if you want to analyze a stock or an ETF, and you want to know what they mean. But most importantly, you want to know how to use them to analyze a potential company or a potential stock or a potential ETF that you'd like to invest in. So I have a very nice example for us. We're going to try to compare or to use the example of two companies in the same sector and then see if we can apply use the pricing, the dividend yield, and the earnings to then learn how to analyze a company or a sector or an ETF. And for example, we're going to use Dangote and we're going to use BUA Cement, two companies in the cement subsector of the Nigerian Stock Exchange. But also more importantly, Dangote is the largest company in Nigeria by market capitalization, and BUA is the third largest company in Nigeria by market capitalization. So we kick off, like I said, what is really market capitalization? And that's the first thing you want to do when you want to analyze. You want to start and say, okay, how big is this company? What am I dealing with here? The market cap is just the number of issued shares multiplied by the market price per share. So if I had a company and I issued 100,000 shares and the market price for one share of my company was one, so if I multiply one by 100,000, that's going to be 100,000 more or less. So my market cap is going to be 100,000. In Dangote's case, Dangote's share price for one, as of last week, is going to be about 215, right? So if we took 215 and we multiplied it by the market the number of issued shares that Dangote has, about 17 billion, yeah, that would give us a market cap of about 365 trillion for Dangote. For BUA, it's going to be about 249 trillion for BUA. So the first question, does market cap really tell us anything if we're doing analysis? Not a lot. It just tells that Dangote is larger by market cap than from BUA. It doesn't really tell us we should go and buy. We just don't buy because something is larger or smaller. So we have that data point, but we can't make a decision on that data point by just market cap. We have to go deeper. And to go deeper, we're going to rely now on the market price. So a primer here now, prices in the stock exchange are really just what demand and supply are doing. If demand is high, then prices will go up. If demand falls, then prices will go down. The market price does not represent, in quote, the real value of the stock, or should we say the intrinsic value of the stock. The market price just tells you how much the market is willing to buy or sell a stock or an ETF to you. So let's make sure we understand that. So what's the market price for Dangote? For we said it's about 215. Market price for BUA, we said it's about 73. Does it tell us anything? If BUA is 73 and it's cheaper, does that mean it's a better stock because it's cheaper than Dangote in the same sector? Not really. We have to compare that price to this concept of earnings. We have to come back to earnings. So how do we do this? Let's determine the earnings per share of Dangote and BUA. So the first thing we've done, we've looked at the market cap. And we've said Dangote is a larger company by capitalization than BUA. But we said we can't really go on that alone. Market cap just tells us Dangote is bigger. To go further, we have to look at the earnings being produced by that capitalization. So let's talk about the earnings per share. We take the total earnings that a company has made and we divide it by the number of issued shares to get the earnings per share. Again, we're going to use the example of Dangote, and I'm just going to give you the numbers from BUA. Dangote 2020 did about 275 billion. That's net, yeah? And the total number of issued shares was 17. So the earnings per share for Dangote was about 16. This means that for each share of Dangote, I get about 16 times the earnings of Dangote, right? If we did the exact same thing for BUA, the earnings per share for BUA will be 2. So we have 16, we have 2. Does it then tell us anything? Yes. It tells us that for each share of Dangote that we buy, we are getting 16 earnings. But for each share of BUA we buy, we're only getting 2. So now we're getting a bit of a comparison here. We can start to say, yes, Dangote is a larger market cap and it's also paying us a higher earnings per share. But to even go deeper, we want to compare that earnings per share to the price, because we want to then say which stock is cheaper. If I was buying BUA for 73 and somebody was buying Dangote for 215, even at the earnings that we've seen for Dangote that are higher, does it mean BUA is cheaper? We have to then look at what's called the price to earnings to get that answer. What the price to earnings is trying to say is this: if I can use a lower figure and buy a higher earning, then that stock is cheaper. Again, let me say it again. If I can use a lower figure and buy a higher earnings, then I'm paying lower. If I'm paying lower, then it's cheaper. Let's use an example. Going back to Dangote, I am taking my price to my earnings. What's the price of Dangote? 215. Yeah. What's the earnings of Dangote? 16. If I did the calculation price over earnings, i.e., PE ratio, I get a PE for Dangote of about 13. So let's say it again. I'm using 13 to buy 16 times earnings. What's the figure for BUA? If we did the exact same thing for BUA, the PE for BUA is going to be about 35. So the same thing, you are taking 35 of BUA to buy 2 of earnings. So look at it. I'm taking 13 of Dangote to buy 16 of Dangote, i.e. earnings of Dangote. But for BUA, I'm taking 35 to buy 2. So clearly you can see that Dangote is cheaper because I'm taking less to buy more earnings. Does that make sense to you guys? So by market cap, we can see that the one company is larger, but we didn't really know anything by that statement. We then went to the market price and did the earnings per share. We then saw that one company was earning higher than the other company. That was important to us. We then did the price to earnings. And from the figure, we then saw that the company that was paying us higher was at what we could get at a lower price than the other company. Remember, you have to compare PE to company or sector to sector. A high PE in an industry cannot be the same as a low PE in another sector because they are different environments and different variables. But in this case, it's the same cement sector. So we can compare like for like and say that this stock is cheaper than that stock. But we cannot take the PE of a cement factory and compare the PE of a bank or PE of an IT firm. So I hope that point is made very, very clear. So we've talked about market cap, we've talked about the market price, we've talked about the earnings, and we've talked about the earnings per share. And we have seen how this all interrelate. Is there any other thing we can do? Yes. We can also talk about the dividends, the actual cash that is coming to me. Remember, the earnings per share is just what Dangote earned. What actually comes to me, the investor, is the dividend. So we can also compare the dividend that is paid to Dangote shareholders and also to BUA shareholders. In this case, Dangote paid out a dividend in 2020 of 272 billion, right? So about 16 naira per share. So the returns, the dividend yield is going to be about dividend, which is going to be dividend paid. Like I said, it's going to be at 16 divided by the price, about 215. That gives you about 7.44%. The same thing for BUA. If we took out the dividends per share that was paid and divided by the dividend by the number of shares on market price, we get a dividend yield as well for BUA for 2.81. So just to be clear, the dividend yield for Dangote is 7, and the dividend yield for BUA is 2. And we got that by taking the actual dividend that was paid and we divided by the price to get our dividend yield. What this means is that for every 1 naira we invest in Dangote, we get 7% back. But for every 1 naira we invest in BUA, we get 2% back in terms of the dividend, not the earnings, the dividend. Yeah. And the dividend yield is a better measure in terms of a comparison, because you can go across industries or sectors or asset class and compare dividend yield to dividend yield. So we can compare the return of Dangote's 7.4 to, say, the return on Nigerian risk-free rate, like the federal government bond. We can compare Dangote yield to Zenith's yield, i.e. dividend yield. We can compare what we're going to make if we bought Dangote or if we bought Zenith Bank. That's a very, very good measure. So just to recap, guys, we've done a lot. We've talked about the market cap. We've asked ourselves, if a company has a higher market cap, does it mean anything? We said not really. It just tells us when it's bigger or smaller. Then we went deeper and looked at the earnings. We looked at the market price and we said, if a company has a lower price, does it mean anything? Not really. We have to compare that price to earnings. We then did the earnings per share, and we got a company with a higher earnings per share than the other one. We asked ourselves, is this significant? We said, yes, it is, because when you do the earnings per share, you're basically saying one stock pays you more than the other stock, or earned you more than the other stock. What we then did was to go finally to dividend yield and said, what's really coming to us in terms of a dividend? And we then compare the dividends paid by one company to the other company. And we said, yes, if you invest in this company, you're going to get a higher dividend yield. So the summary is this: if we are looking for a company to invest in, what are the elements we should look out for? Number one, we should look out for a price earnings that is low in the same sector. That's a caveat. So we can do PE of cement and compare it to PE of banks. So in the same cement industry, we want to get companies that have a low PE. Why? Because they are cheaper. We've shown that to you. Number two, we want to get a company that has a high earnings per share. Why? Because I'm earning more per share that I buy. Number three, we want to get a company that's paying us a higher dividend yield. Why? Because I'm making a higher return per naira invested in that company. So if you're going to do a stock screen, you will say PE ratio low, earnings per share high, dividends per share high. You can compare your dividends per yield across asset classes, but you want to compare your PE to the same sector or to the same market. That's just an elementary way for you guys to build out a stock screening scenario for you, and also to understand how this works. So again, we want to talk about this week about earnings, dividend yields, pricing, P ratios. I hope we have achieved that, and I hope you now have a better understanding of how you can use it. Make sure you also Google. There's lots of free stuff online and read more about this. You have to understand this concept. They are very, very key for you. Thanks for listening, guys. Keep following us on the Twitter, FinPlanCalu1, and keep sending back your feedback. I appreciate it. So listen, share, subscribe, tell your friends about the podcast, the way I see it. I appreciate you guys. Do have a good day. Bye.